Hey gang, good to see you again today on our YouTube channel. We're going to attempt to help you answer a question that might be at the forefront of your mind, and that is this: how much of a payment can I afford if I'm looking to purchase a home? Maybe you've asked that question. To be sure, your payment for a mortgage is going to be different than if you were to rent an apartment or a duplex. So ultimately, you're the one that has to decide how much you can afford. We're going to refer you to your credit union, to your mortgage company, or to your bank to help you with the specific guidelines and the specific details. Today, what we're attempting to do is to help provide you with some of these components that make up a general mortgage payment that you pay towards that loan. And so you take that, do your homework, and then at the end, we'll look at some next steps if you're looking for a home. Your typical mortgage payment is made upon or based upon four components. There's a couple more that could be involved in that, but the acronym PITI, P-I-T-I, I pity the person that has to make this payment, maybe consider that. But the PITI is based upon four things. Number one, it's the P stands for principal. That's the payment that you're paying towards the lending agency, the amount that you borrow, and you're paying that back towards that principal or that amount that you have borrowed. The I stands for interest. Interest is the cost that you're paying for borrowing that money. And so part of that payment is going to involve principal. You're paying that loan down with the principal or the P part. The I is the interest part that you're paying that institution for loaning you the money in the first place. The T stands for taxes. Now the tax amount is going to be about equal to about 1/12 of the yearly tax bill. So 12 months of the year, property taxes are for the year, and so they'll take 12 months of that, and basically you'll pay about 1/12 of that each month. They'll go towards your mortgage payment. And then also, like it, is the other I stands for insurance, the amount equal to 1/12 of the yearly insurance premium for the property. Now, you're going to have a payment that's going to be based upon at least these four things. Typically, your mortgage companies are going to want to escrow the taxes and the insurance. You may be able to do that differently, but oftentimes your mortgage companies, your credit unions are going to want to take these two amounts, the taxes and insurance, take that part of those payments and put it in an escrow account for the servicing company to pay for your yearly property taxes and your yearly insurance. They want to do this typically because it minimizes their exposure from as far as financial institutions. It minimizes the risk of foreclosure due to unpaid property taxes or due to the home that is not insured. If there's an accident, if there's a natural disaster, they're going to want to make sure that they have secured their assets. So if something tragic happens, the insurance company, having been paid properly, can cover that. So that's typically the four components of that loan. Now, you may be able to find some information on this as far as, let's just say you go and you purchase a home, you go under contract. You're going to make sure that you have researched kind of what the taxes are. You can find that on the Central Appraisal District. You can find the previous year's taxes. That can give you an idea of what that would look like. And your agent, if you have a real estate agent, can help you with that. The homeowner can provide that information, as well as when you're looking at putting a contract on a home, you're going to want to go ahead, especially after you've got it under contract, you're going to want to make sure that you do your research and find an insurance company. One, you have to have that information at closing. You got to have it insured before you purchase it. Most mortgage companies are going to require that. And then the other thing is, just for your general knowledge of, hey, we're shopping around, which insurance has the better rate. Now, a couple of things we haven't talked about this morning or on this video yet, PMI and MIP. These are actually a little different, but they're similar as well. PMI stands for Private Mortgage Insurance. If you go with a conventional home loan and you don't have 20% equity, or you don't put 20% down to have equity towards that, most of your mortgage institutions are going to require that you, part of this payment, which increases the payment, of course, goes towards PMI, that private mortgage insurance. That's for the conventional loan. MIP is mortgage insurance premium, and that's for your FHA loan. Again, same concept here. You're not insuring, you're not paying on this for insurance for you as the buyer. These two types of insurance, PMI and MIP, actually you're paying money so that the lender is insured. So if you want to go ahead and give that money to those companies to insure themselves, that's fantastic. If you want to avoid that, if you work it in your budget, you pay money down at the front, and it has to be about 20%. You have to talk to your mortgage institution to find out what that really is. And the upside is, let's say you can't come up with that money up front. Once you have 20% equity in that home, typically you talk to them about dropping that because it removes that risk for them, which is an incentive also for you to be able to take that off and hopefully reduce your payment. Now again, what you're going to want to do is you're going to look at these different components of that loan payment. You can do a lot of research on the internet. You may consider finding a real estate agent if you're here in East Texas. We'd love to help you with that. And then at the same time, you're going to want to go ahead and connect with a mortgage institution, a bank, a credit union. Your agent can help you with that, a real estate agent. Here's the last thing I want to just encourage you with. Really, it would be great to get with a mortgage institution, real estate agent, and get you pre-qualified before you really even begin to look at homes and get serious for that. Because a lot of sellers are not even going to let you tour their home until they know for sure that you're pre-approved with a bank that says, hey, yep, we're going to agree to loan them that much money. It's not a hard process, a difficult process. You'll have other things to go through to get fully approved. But it will be a great idea for you to do these things. But what we wanted to do today was just provide you with, again, some of these general components of that mortgage loan payment. And then you do the homework. You find your agent, you find your institution. Give us a call, shoot us an email if you have any questions. If we can help you, Keith Kelly, that's KeithKelley 2425 at gmail.com. You can email us or you can call me 903-261-2490. We hope you have an amazing day and happy home hunting.